historically, lowering of interest rates means there's a weakening of the economy, right? Which we're clearly seeing in Canada. So you have to factor that in for sure. But think of all the other dynamics that causes, right? So companies that have any kind of debt, their cost of capital actually goes down, right? Their interest expense goes down. So it somewhat lessens the risk from that standpoint. But also think from a buyer standpoint. I just mentioned private equity, right? Private equity, most of the times when they're making an acquisition, there's debt involved. So we were a little worried when interest rates went up. We were worried that this private equity buyer was going to disappear because their cost of capital went up significantly, right? So now they're not able to buy as much as they can. But look, now that their costs are coming down, they're more likely, even more aggressive to be buyers in this space. So we look at it a little bit differently. Yes, there's an economic risk that you have to factor in, but a lot of that gets priced in no matter what. So when you're looking at these opportunities, now you got to look at them with, again, a different lens on, and look at them as potential private equity acquisitions. When we look at a lot of the companies that we get interested in, we say, would we buy the whole company out? And if we could, what would be the cost of doing that? So we think as private equity investors. So in my mind, the lowering of interest rates, while it's clearly an indication of a weakening economy, the buyer and that excess capital that's out there is going to get drawn into these even more because their cost of capital is lower and their opportunity set is shrinking.